Good Monday morning, half an hour away to the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories, Asian stocks under pressure with China set for losses after Beijing's plan to help local governments deal with hidden debt underwhelms.
Yep, China's disappointing inflation numbers, which also came through on the weekend, adding to the gloomy market mood. Consumer price growth stays near zero while factory gate prices slide for a 25th straight month.
And Bitcoin topping $81,000 for the first time on optimism about Donald Trump's embrace of digital assets and the prospect of crypto-friendly U.S. Congress. Well, there's really just two major themes that are running through markets at the start of the week. On the one hand, you've got US stocks coming off their best week in a year. On the other hand, you've got that story around China and that continuing disappointment because we had that debt swap plan on Friday. That underwhelmed. We followed it up with that disappointing economic data, the inflation readings over the weekend. So that's really the two themes that are coursing through. What's really dominating so far in the broader benchmark is what's happening in China, because you can see here equity is just a little bit under pressure. US futures, though, just continuing to push a little higher. And you've got the US dollar. Again, we have seen it fluctuating a little bit in the early going, but the definite direction, it seems, especially when we get the US inflation figures later this week, perhaps we see stickier inflation on the way down. That tells us that the dollar could be strong as traders really rethink their expectations around what happens for the Fed come that December meeting. So that's the state of play here broadly. Also continuing, of course, to monitor those geopolitical headlines, that event risk as well, because you've got TSMC here just a little bit under pressure so far. But the story there was a Reuters report, and we do understand that the US has told TSMC to stop sending certain AI chips to China from Monday. So that's the story there. Let's change on, because again, it's, as I said, that story around the US, President Trump's election, what that means, and it's really that focus on Trump trades. And if you really want to focus on one in particular, probably look no further than Bitcoin. I mean, we just pushed above $81,000 a token for the first time ever, still up around 5.5% over the past 3 days. So that's the story there. Bitcoin very much one to track. And as we said, that focus on what happens in China today, because the Golden Dragon Index on Friday really gave us that sense of the first reaction to this debt swap plan. If you just change on, taking a look at what happened with the Golden Dragon Index in particular, a huge slump. You can see that the last close down 4.8% on Wall Street. Again, the guide for today, Dave, not looking that positive. No.
So I guess in many ways, looking at the glass half full, things can only get better, we hope, from here. A couple of other things to note as we get underway, of course, today and throughout the week. So it's a big earnings week. We'll get to that in a second here. So as far as today is concerned, we'll see whether markets will continue to look underwhelmed going into the open today. So broadly speaking, as Bell was pointing out, we're down 0.5%. And certainly the price action on Friday does suggest some weakness coming through in the early goings of this Chinese market as we look ahead to the open today. Other things, too. So as far as data goes, we are in the window for credit numbers to come through that could come over the next couple of days or so. As far as earnings today, it's Leap Motor, which then takes us into the next page where you have effectively your biggest tech companies reporting in China this week. Everything from Baidu on Tuesday, Tencent Wednesday. Going into the latter part of this week to wrap things off, we will get earnings out of Baba coming through before the coming weekend. So, yeah, apart from this, Bell, yeah, I mean, earnings, tech, very much in focus, as you were just talking about there.
Tech, really the major one to be watching across the course of this week, and it could actually help or hinder, I guess, the direction of Chinese equities from here. But that question, of course, is the stimulus measures we've seen so far, is that helping to lift sentiment? And a couple of the ones that really to watch, I guess, you could keep a watch on what's happening with Tencent, that gaming revival. Does the renaissance continue? JD.com, of course, that's really the stimulus story. Alibaba as well, and then Baidu, more that monetization around AI. And are we going to start seeing the Baidu World event, for instance? We were speaking last week about those glasses that could be unveiled, so it's that AI hardware play in focus as well.
Yep, so there's the micro, and back to the macro here. So we finally have more details now on what this big number looks like. On Friday, the press briefing unveiling, of course, the fiscal push, $1.4 trillion, this lifeline to help local governments deal with their hidden debts, but really stopping short of unleashing new stimulus at this point. Let's bring in Min Lo, our China correspondent, to talk us through the details of what we know from Friday's announcement.
Yes, so the headline number is that 10 trillion yuan in debt resolution package. It's 6 trillion yuan in special local governments refinancing bonds that will be spread out over 3 years, plus another 4 trillion yuan that's coming from the regular quota of local government special bonds over the next 5 years. And according to the Finance Minister Lan Fo-an, he's saying that this will reduce the local government's hidden debt by about 12 trillion yuan by the end of 2028. It will free up 600 billion yuan in interest payments that the local government can use to expand investment into the economy or to pay back civil servants' salaries. But I think what markets were really disappointed by was the fact that there wasn't really any additional stimulus or at least any additional number tied to things like the property sector, boosting domestic consumption or banks recapitalization. Although we did get forward guidance, the government pledging to have a more forceful fiscal policy in 2025, including raising the fiscal deficit, expanding the use of local government special bonds to buy up idle land, and expanding the equipment upgrading program as well. And we have one analyst talking about the vulnerabilities of the Chinese economy given the trade surplus that we've been seeing. Have a listen.
China trade surplus is not a strength. It is a weakness. It is the sign that the Chinese economy is not properly balanced between domestic consumption and exports.
So you have the trade surplus really flipping from strength to weakness amid this threat of more tariffs from the U.S. And I guess the next window we want to watch for is the Central Economic Work Conference, when the government will mull over the fiscal budget deficit for next year, although, of course, that's only going to be announced in March during the 2 sessions. But it does look like the government is not really in a rush to pull out those extra fiscal power until we get more certainty over what Trump's policies are.
Yeah, leaving a little bit of dry powder. But you mentioned, of course, nothing really targeted so far at property, at consumption. How did that play into the inflation numbers then over the weekend?
Yeah, I mean, the overall inflation number is still not looking very pretty. If you look at consumer price index, well, both consumer price index and the producers price index are missing expectations there. Consumer price index coming in at 0.3% for the month of October. That is below consensus estimates of 0.4%. Producers price index still in negative territory for the 25th straight month. And it came in at 2.9%, worse than the previous month and also below analyst estimates as well. And so the only, I guess, bright spot we see here is the slight uptake in the core inflation. It moved up from 0.1% to 0.2%. But again, the stimulus impact hasn't really translated into inflationary pressures just yet. And that's why markets are so anxious for more stimulus from the government.
That was our China correspondent there, Min Lo. And let's bring in Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. And Ecaterina, maybe from a fiscal management perspective or a prudence perspective, this could be the right thing to do. But if you're concerned about the growth momentum for China, this doesn't really seem like the right thing to do.
Yeah, I mean, as we talked in the previous sessions, I think China needs to course correct its economy. It needs to move away from heavily from investment more into a consumption-driven economy, away from kind of manufacturing and more into services. And that course correction takes time. I would say gradualism here. I think markets is probably disappointed. But if you look at what the policymakers are doing, they certainly acknowledge from 26th of September when they started putting these measures in place, they acknowledge the state of the economy and they're making steps to realign the economy to where it needs to be. And I would say gradualism is probably what the word is for Chinese policymakers. I think they will wait and see what the response from the current measures are, and they will implement going forward additional measures.
Yeah, I guess to your point, right? A lot of the things that they have to solve are multi-year issues, right? That won't really solve themselves over a matter of months. Where do you think valuations are? How do you think about valuations in this Chinese market now that we're done with the initial resets? Are they fairly valued right now? Like, what do you think leads to the next expansion phase?
Well, the next expansion is very much driven by will the inflation come back, right? Because ultimately, will the earnings come back, right? And I think this is where it anchors around because the valuations at the moment, they were not stretched before the measures were put in place in September. But now, after the measures, the market has rallied. And from here onwards, we need to see earnings recovery. And that's dependent on inflation coming back, consumption being a little bit stronger than what it is. So certainly a little bit more patience is required.
Okay.
a little bit more patience. Then you have, of course, Donald Trump entering the White House. There's the tariff risk as well. Does this just mean that the outlook for China is not only a multi-year recovery for sectors like the property one, but also that exports are going to be impacted next year?
Yeah, I would say this is a concern, and certainly from Trump coming into the administration, we move from this political uncertainty to policy uncertainty. So we don't know what the measures he'll put in place, the scale of those measures they're going to put in place. But one point to say certainly is that the China economy is in a different state to what it was in 2016 versus what it is now. The share of GDP of U.S. imports is much lower, so it's gone down from around 9% to 3%. And certainly there's a lot of diversion that has happened. So corporations have prepared to some degree. Not to say that this is not going to be a shock, it is not going to be destabilizing, but I would say it's to a lesser degree. And of course, the important, as I said, if the economy managed to rebalance to more consumption, they'll be more sheltered from external risks.
That's a big if, though. And, you know, we only find out again in a couple of years if it happens. Take us through what you're thinking here. We're moving from, I like this, we've switched from political uncertainty to political uncertainty. What does that mean exactly? From
political to policy uncertainty. So
okay.
Certainly the policies that Trump is looking to put in place are not known. Obviously, he's talked about the fiscal, he's talked about deregulation, he's talked about tariffs, he's talked about immigration. But the scale of those have not been announced. And I would say the key question is, what's the scale of those policy? And ultimately, what will be the China response to that, right? So, and I would say the market behavior and certainly the ability of China to deal with this will depend on the scale of it, but also how they respond to those measures.
So, I mean, suffice to say, do you think markets will remain range-bound over the next few months until we get more certainty on whatever Trump does or whatever new policies China introduces to maybe offset that?
Well, it depends which part of the markets you look at. But I would say for China at the moment...
Greater China equity markets.
For China equity markets, certainly, as I said, there will be a lot more volatility around it.
Okay.
I think the upward trend from here, as I said, is very much... I call it was a technical recovery that we've experienced. So certainly the support on equity market, the support on some degree on property, the support on fiscal, which has had a positive sentiment impact. But the fundamental picture has not changed yet. We haven't seen that in earnings yet. And we'll see the earnings this week of some of the big tech companies. We'll see how that manifests. But we need to see the earnings recovery for investors to deploy into a more constructive way rather than a more tactical way.
Right. That's the China story. We'll have more, of course, in a moment there with Ecaterina Bigos there, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. Just ahead here on the shows, we'll be talking through also Chinese equities with China Renaissance to discuss, well, the disappointment, question mark, around the lack of additional major fiscal stimulus coming up, major measures out of Beijing. Plus, we'll have a look at Singles Day, 11/11, as Chinese consumer sentiments. With Goldman Sachs joins us around this time in the next hour of the China Show. Just 17 minutes away from the opening bell. Futures are pointing down ahead of the Monday Open. You're watching the China Show. Welcome back. We're looking at futures now pointing, in fact, we should be at session lows on some of these contracts right now. Going into the opening bell today, we're looking at also, some of the other market stories to tell you about. U.S. futures are slightly to the upside. Of course, Bitcoin and crypto is really what's dominating proceedings this Monday, this point in Monday. The reference rate of the day's out should be coming up bottom of your screens very, very shortly against the U.S. dollar. Still with us here on set is Ecaterina Bigos, CIO for Asia ex-Japan at Core Investments at AXA Investment Managers. We're done with the elections. We're done with the Fed meeting, which was the day after, of course. Where does the Fed go from here? Well, is there a window to cut before the end of the year, or should we put that off to next year now?
We do think there is a cut in December. So I think the risks are fairly balanced between the labor and the inflation, and I think the indications of the guidance are very vague about the Fed intention to cut in December. We have the view they will cut. I think the uncertain part or less known is 2025. Based on the election outcomes, obviously the market expects that 2025 will be a lot more inflationary, coming from fiscal stimulus that Trump is intending to put in place, and tariffs, of course.
Right.
And certainly that could derail the picture or the trajectory for the Fed to be able to normalize monetary policy in 2025.
What about the question around the sustainability of the debt load as well? Do we start to talk a lot more about that?
That's a part of it, and I would say at the moment the market are tolerating it, and we've seen actually, in fact, the treasuries on the back of the spike in yields, the demand for treasury actually has increased. So I would say U.S. is still in a very privileged position to be able to continue on that level, but at some point it will need to be addressed, and that point is probably coming closer in 2025 and 26, when if there's additional pressure from that fiscal package and the yields were to spike, certainly that will need to be addressed in a little more significant manner.
Yeah, markets look ahead. So, the impact, we were talking during the break that the impact to the U.S. economy could come in 2026. Do you think, though, yields at this point might even test cycle highs? I mean, is the likelihood for higher yields then lower yields from here on, I guess is a question.
Well, on balance, if you look at where the rate expectations were at the first cut in September when the Fed started 50 basis points, the market were seeing rates around 3%, right? That's completely repriced, and largely has been repriced because the data has come a lot more stronger, the inflation has come a lot more stronger. But importantly, we have an administration which is deemed to be a little more inflationary. And certainly a higher level in 2025 is very, very much the narrative that we expect.
Okay.
So then that, of course, means that it could be a headwind for equities. How do you want to sort of play that market then? Do you really want to focus on the so-called Trump trades and just double down on the sectors that you think are going to benefit?
Yeah, and I think that you rightly said so. Look, a higher cost of capital depresses valuations, but at the moment there's a positive sentiment and a positive impact potentially on the fundamentals of the companies from easier taxes on corporations, right? So the broader pro-growth policies I expect to have a positive impact. I would say for 2025 that puts the growth trajectory for U.S. in a positive limelight. I would say that's positive for equities more broadly. That's positive for places like credit. We've seen spreads tightening significantly. Now the concern is rates and the risk from rates, and certainly what is going to be then the longer-term implication of higher cost of capital to the valuations for equity markets.
Does that, I mean, you talked about how tight spreads have become in the credit markets. The other bit, too, is, there is an all-in yield there for investors if they want to hedge. Do you think we're underestimating the value of credit given just the uncertainty out there? What is the value of having credit in your portfolio right now?
Oh, we're very constructive on credit. I mean, all-in yields have not been attractive for the last decade, as attractive as they are now, certainly. Right. It's a diversifier. It certainly provides a shelter or ballast to the performance in the equity market because you have an inherited carry that shelters you for potential volatility. What we do advise clients now, and this is a change to where we are, let's say, in September to now, we say do pay attention to duration or the rates risk, which is going to be a lot more negative, potentially detracting from performance. So potentially staying shorter duration credit or hedging that rates risk. It's certainly probably a way to go in 2025.
You mentioned, of course, the corporate tax cuts. What about on the consumer side and those being extended? How does that sort of play into the broader consumer theme then in the US?
I think that if you look at the latest data, consumer sentiment is staying quite resilient. And the part that has been supported is the fact that labor market, i.e. the jobs, are very present. If we're not going to see layoffs in the U.S. economy, there's no reason for destabilization of the consumer sentiment more broadly. So I'd say a combination of strong labor market, economy that's staying resilient, and potentially pro-growth measures that are supporting that equity market and supporting risk assets will certainly lead to a stronger consumer confidence and broader kind of investment confidence as well.
Does that mean the U.S. equities remain just the only game in town? And I'm wondering if that group has just simply the cleanest among all the outlooks out there. You look back at history, agnostic of the political cycle, EPS has just gone up and up and up. If you look back all the way back 100 years, that seems to be very consistent.
It's very consistent, and I would say it's probably agnostic to policies. Actually, the earnings have delivered consistently, as you said, over time. And I would say U.S. exceptionalism still it prevails. But what are the repercussions of that? When we look at technological advancement, automation, that has implications on other equity markets, places like Japan, to some degree in Europe, because the supply chains, places like Taiwan as well, the supply chains are more broad. So we always said for investors in this new investment era is to break down the investment universe in themes and look at what are those themes that are keeping the market afloat and are going to stay more resilient despite of the cyclicality of the macroeconomic environment. And I would say themes like automation tech are expected to benefit places like Japan, places like Taiwan, Asia more broadly, and certainly US, because US is leading with it. But then, of course, the supply chains have positive spillovers on other markets.
Curious if you can talk to Taiwan in a bit more detail, because of course on the tech side and that automation, we've seen the big run up in the benchmark this year. But given the question mark really around how President Trump next year handles the question of Taiwan security provisions, what do you actually expect to happen there?
No, I think the importance of Taiwan remains. I mean, they're the biggest supplier for chip manufacturing. We've seen the ambition for U.S. to diversify their supply chains, onshore some of them back home, but it still stay a key supplier to the semiconductor industry, which again is going to stay resilient. Assuming that the theme is going to stay, assume the AI is going to start to show indication of benefits and the broader economical applications, that certainly will support the market going forward.
Ecaterina, Bigos, thank you so much for spending your Monday morning with us. Have a great week ahead. Hi to the team, please, there. CIO for Asia, ex-Japan Core Investments at AXA Investment Managers. Okay, some breaking news coming through in the early goings. We're 2 minutes into the pre-market session, and equity markets in Hong Kong are off a cliff right now, 2.3% to the downside. On the Hang Seng Index, the Hang Seng Tech Index, we showed you that earlier on, we're off by 3%. On that benchmark. More on the market story just ahead. This is the China Show. Welcome back. You're watching the China Show. We are off to a rough start to Monday here, out of bed in the early going. So I guess in many ways, Belle and I were talking about this during the break. It might have to do with the fact that we did get, as expected, details in the fiscal measure, but also we didn't really get anything so far as the consumer goes. And given the run-up we've seen last week, you know, Hong Kong stocks did snap out of a 4-week skid last week. We could be seeing some selling at the margin here.
Yeah, that could be part of it as well. But I think it's quite incredible when you look at that trading action versus what we had in the US.
Oh, yeah.
Because it was the best week we'd seen for the S&P 500 in a year. And we were just talking then with Ecaterina Bigos about that US exceptionalism, and that case still remains very much intact. So, yeah, negativity ahead, and we can check on some specific stocks as well. Analyst actions, Leap Motor, for instance, one to note today because we've actually seen it rated a new buy. Although, of course, we have earnings watch for that company as well. SMIC, China Overseas Land, both of those have actually been reduced or cut by different brokerages. So, yeah, I mean, probably just going to add to further negativity. That's the story there. But let's also take a look at what's happening in the e-commerce space, because you were just mentioning some of those big moves. We're seeing a big drop there. Wow, Kuaishou down 6%. JD.com as well off 5% in early trading. Crypto stocks, of course, one to note. Given those big moves, we saw crypto reaching $81,000 a token. There we go. If you want to find some bright spots today, look no further than anything linked to digital assets, Dave.
Yeah, going into the opening bell, so that's a bright spot. CSI 300 in the early minutes, down about 1%, 4,000 in play this Monday morning. You're watching the China Show. The opening bell is just next.
Welcome back. You're watching the China Show. We're counting down to the open of markets, and if futures have been any sort of indication, Dave, we're setting up for weakness across the board here today. Hang Seng futures, for instance, down 2.3% in the early going. But there's two different themes here really at play. You firstly had the NPC briefing on Friday. That certainly underwhelmed on the fiscal front. And then in addition to that, you had those US eco numbers over the weekend. And again, telling us that deflation really is the key word there to watch.
Yeah, we're near zero still on the consumer price inflation gauge. I think we're down 25 straight months in the producer prices. And really, you know, that's really something that's been fairly consistent. We've heard from many, if not all of our guests. Until we get the housing market and inflation coming back, does China remain simply a tactical trade at best? Big earnings, of course, that we're going to get through this week that will tell us also a lot about where we are as far as this whole margin compression conversation is concerned. On top of that as well, it's hard to look at this in a vacuum. U.S. equities performed very well last week, so I guess in many ways the juxtaposition between something that's perhaps more clear right now, given how valuations in China have reset. We're down 4% on the CSI 300 in the early goings, and some of the consumer staples, of course, bottom of your screens, 1.2%, 1.3%. On Guizhou Maotai, Wuliangye down about 2% in the early goings. Flip words, please, and have a look at where we are as far as Hong Kong, where you are really seeing, in terms of price, a bigger pullback. As you can see, we're off by 2% on the Hang Seng and Hang Seng Tech Index, which is actually a good thing compared to just a couple of minutes ago. We were off by over 3% in your pre-markets. A lot of big earnings coming through. This one's coming out on Friday. This one's coming out on Wednesday. And we have some other big companies scattered throughout the week. I believe Meituan is also this week, if not mistaken, or the week after. In any case, it's forthcoming, suffice to say. Very quickly, I guess one bright spot, if you are looking for one bright spot here, is crypto. 81,000. We were past tens above it. We're a little bit below it right now on Bitcoins. You are seeing that coming through as far as some of the crypto-related equity markets are concerned. Zhejiang Leap Motors out with earnings today, and SMIC, we just have that on our boards, just on the back of this news out of Reuters that the U.S. has asked TSMC to stop some of its AI chip shipments to some of its Chinese customers. Apart from that, yeah, we'll see what the week holds. I think 20,000 is a level to watch today, Bell. It's a level that's held since that initial policy pivot. So I guess in many ways we have settled into a higher low. We'll see if that sort of level holds today, of course, amid the, I guess, the lack of details so far on what this means for consumers. But certainly they did deliver the 10 trillion, 6 trillion on the debt swap, 4 trillion incrementally throughout the next few years. Bill.
Yeah, certainly we saw that initial reaction in the Golden Dragon Index on Friday, and the MPC really seemed to underwhelm investors. But SMIC to note as well actually was cut to neutral at CCB, and Meituan as well to note as well, because Dave mentioned it. Earnings are due on Thursday, but it's certainly a big week for earnings across Asia Tech. You've got Tencent, Alibaba. Also to note the Baidu World Day as well, and this is going to be where we get perhaps more of an indication what they're going to be doing around the AI hardware play. But yes, the theme today, very much that reaction to the MPC, also the inflation numbers over the weekend. But let's get more, bring in Andy Maynard here. He's Managing Director and Head of Equities at China Renaissance. And Andy, we were just saying there in the break that when I was reading through your notes, I sort of got the sense that you had mixed minds about what was announced on Friday and mixed reactions. So what was it in aggregate, do you think?
Well, I mean, without a shadow of a doubt, we seem to have every press conference since we've been in this stimulus mode that seems to disappoint the market. And maybe the market gets over-exuberant in terms of this big bazooka that's going to come out. I do think that the MPC obviously underwhelmed, as you can see that from the market's reactions, both in the ADRs on Friday night, but also, more importantly, here today. But I do feel that there is a belief and some sense that maybe they're holding back. Maybe they're waiting for the Trump administration to start. They're maybe holding to see what these tariffs come aboard. Do they come into a 60% across the board leveling, or do they become more targeted in terms of some specific stocks, specific sectors? So I do feel that there's a lot more behind the MPC. I do feel that there's a lot more behind the stimulus. And I think that the market at the moment is having a very negative knee-jerk reaction. It's bouncing quite nicely as we speak, but I still think from a volatility point of view, we're not out of the woods by a long, long stretch yet. And I wouldn't be surprised if we stay in this sort of quagmire, if it were, for the markets between sort of 19.5 and 21K in the Hang Seng until the Trump administration comes in and until there's some level of conviction as to what it actually means for China.
Well, I guess implicitly with that range you just laid out there, do you think we've settled at a higher low at least here on
I do
this market?
think so, yeah, I do think so. And actually, if you step it all the way back to, say, late August, September, we did run incredibly, incredibly fast on a lot of belief and a lot of rhetoric and a lot of noise and a lot of non-concrete measures. And I'm not surprised that the market came away, because I don't feel that China, from a domestic point of view, backed up those statements. They're starting to do some now, very piecemeal, slowly going into the market. And I think it's quite healthy for the market in a degree, right, that we start to hold rather than continue to rally all the way up to sort of 25K on fumes, really. Also, I think what's very positive is the volumes going through Hong Kong. And we've gone from a $10 billion market in the summer to 21, 22. Some of that you have to temper a little bit in the fact that southbound is such a massive component now, at almost close to 50% of the day's turnover. So but the positivity is that liquidity is there. So people are backing it. People are running that trade. You mentioned earlier, just on your brief, about this is a short-term transaction, and I can get that sense, and I can get the sense still that the global long-only investors, in particular, are still skeptical. I don't really feel that they've come in any real magnitude and size. I think the EM funds have definitely gone back to equal weighting China because it's been a nice play for them. But going forward, US domestic is still going to be the number one market. What's number two? Is it China? Could it be China? EM under Trump is a difficult space now. It really, really is. And does China have probably the only capability to compensate some of those Trump moves? Probably yes. So I do feel that people are still quasi-positive, to a degree concerned about the volatility, a little bit sceptical in the short term, but I think for medium-term view, you'd still want to be long China than short.
Because you've just actually been in New York meeting with investors there, so I'm guessing that's sort of the tone that came across in the conversations. Correct me if I'm wrong, but also in that, where are you advising then people sort of direct their money? Because there has to be some opportunities in a range-bound market as well.
Totally, and also sector-specific and stock-specific, right? The first thing I want to say is New York last week amazed me, number one. It was a surprise. I expected the tone and the rhetoric about anti-China, especially from Friday onwards, was going to be so exhausting. And it's been a difficult place working for a Chinese investment bank going to the US in the last couple of years, because even getting airtime with a lot of these global clients is difficult because they've got so much alpha and opportunity elsewhere in the world. But I was surprised that it wasn't all negative this time, compared to my last trip, which would have been sort of early summer, where it was very, very difficult. A lot of clients still felt, this is a knee-jerk pullback. It's a disappointment. We can go from disappointment to disappointment, but I'm not giving up on it. And actually, there was a lot of clients that were still holding sort of major beta plays like FXI, KWEB, as a way to not have to specifically choose, but just to keep some weight in. Because remember, if you've been underweight China, your performance 3Q has been pretty bad. Relative to where the market's gone and relative to where the other global markets have been. So I was surprised at the fact that they're not as negative as I expected them to be. In terms of sectors, you can go through super high risk and pick up the consumers, even the property stocks, which I wouldn't advise, but you could go to that level. Or you could stay in the sort of middle ground, sort of defensively, which would be the e-com names, the streamers, the gamers, which again, from a domestic point of view, seems to have a complete 180 degrees about what the regulatory authority thought about that space in the last sort of 18 months. And I feel that they recognise and realise now that they need to have some sort of backing from some of these corporates in terms of trying to aid and abet the Chinese domestic economy to go forward.
It's interesting how you phrase that, because nuance is extremely valuable and important at this point. I mean, what might be good for the market might not be good for the economy shorter term. And I'm wondering how receptive global investors are to that notion that, yes, we got something on debt swaps. Debt swaps is probably what you need longer term. It's not sexy direct-to-consumer coupons, which probably the markets want. So I wonder how receptive global investors are right now to the concept.
I agree. And again, that's kind of this knee-jerk reaction that we always seem to have in the market, and we always seem to disappoint in the fact that the market is just so exuberantly looking forward to the sprinkle on top, direct consumer intervention, right? Direct play into pumping up the domestic economy. I think from a, again, medium-term point of view, you've got to look at it more systemically. You've got to think, okay, China is moving step by step by step. They're taking their time. Maybe they're going to take a little bit longer time now post the Trump election victory, and maybe they wait to see how that plays out. But overall, there is a clear conviction from China Inc., the Chinese authorities, that we have to do something for the domestic economy in order to continue to stimulate and to push forward in terms of either the targets that they've set themselves and or the global expectation of what the world's number 2 economy should be. So I feel that we're in play. Is it going to take longer than the market wanted? Definitely. Is the market going to be continually disappointed by these news conferences, announcements that don't have that bazooka type effect, then yes. But slowly but surely, again, if we get back into the index levels, if we can build that base at 19.5, 20.5, then it puts us in a very, very good position to move forward if and when those actual direct stimulus come into the market. And I do feel that most global investors now, I wouldn't say have a rosy view of China, but they have a less skeptical view of China. And I do believe that they feel that, wow, okay, my EM portfolio specifically, it has a lot of stresses now, has a lot of risk, and maybe China is an easy hedge to that risk. It is clear from a DM point of view, developed markets point of view, the US domestically is going to continue to stand out. But with the dollar going so strong, and we expect that to continue, where do I put it? Plus, does the MAG 7 continue to run and run and run? Or at some point, is it going to take a breather? And if it does China look, again, to be a great hedge to putting some dollars to work, relatively cheap to PEs and historics, with the backup that China is going to continue to aid and abet the market to go forward?
I guess it's also the question of how individual companies are managing in that economic environment in China as well. And we were just talking before about in the e-commerce area, for instance, there's sort of been varied approaches to even the 11/11 shopping festival, and some have kind of gone for that ultra low margin approach where it's just low cost. Others are taking more of the premiumization play. So how specific do you need to be, and looking at how each company manages the context?
I think really specific. I mean, this is a real, again, let's just say that we stay range bound from the index point of view.
Right.
But specifically from stock point of view, you've got to be really, really careful in your picks, right? I feel the e-com space, there's going to be winners and losers, definitely, right? You know, again, in the US last week, Baba is definitely not deemed to be a winner in that space, whereas Pinduoduo or JD might be. So I do think you have to be very, very specific. I think if you, as I said before, if you really want to risk, then you're in the, you're in the consumer space, even the hotel space, even the restaurant space, even the food and beverage space, whether it be Baju or China Resources Beer or something like that, you know, because that is going to have a direct impact to any sort of stimuli that comes into the market and pushes forward. Even names like Mao Yan on the entertainment side, you know, is getting a lot of decent support and a lot of decent conviction. Names like Potmart as well have done incredibly, incredibly well, but it is always the low end of the local economy that we're seeing. Meituan, again, is the poster child. I think Meituan clearly is a name that people would like to hold. We would stay convinced that you'd want to hold Meituan into this, and you would definitely buy on dips. To avoid, it's got to be definitely the property side still, right? And I think, David, as you mentioned earlier on your intro, that's still the elephant in the room, right? And yes, the debt swap is going to make a lot of headaches to a degree be pushed further down the road, but I do think that there are some sectorial spaces where you still want to avoid going into this.
Well, okay, what's one ETF that I should hold right now?
I would hold KWEB.
Okay, KWEB?
Yeah, KWEB.
Okay.
Or even FXI. FXI gives you a broader... You're not really picking. I mean, again, we mentioned Hang Seng Tech just then, which is basically KWEB is in the US, added some ADRs. But those are the type of names that if you just want to hold China, hold a position in, try to capture some upside, have the liquidity safety net that if you need to get out, you can get out very quickly because they're super, super liquid. But even in the US, it's interesting to note that those are the two that everybody keeps talking about.
Okay.
You know, let's just hold KWE. I'm going to play China. Let's just hold an ETF, and let's hold an ETF, KWEB, probably higher risk, that has definite upside to stimulus coming into the local economy, more so defensively FXI.
All right. Yeah, I think the folks at Crane Shares are smiling right now. Andy, thank you so much. Andy Maynard, their Managing Director, Head of Equities at China Renaissance. Right. Plenty more here on the shows. We talked about the consumer just there. So Goldman Sachs joins us in about 30 minutes to help us unpack really what specific segments within the consumer space you want to have exposure to at the moment. Markets are off lows, but off compared to Friday. This is Bloomberg. Right, welcome back. So, the big market story today is really crypto. So we took out 81,000 earlier on. In fact, we took out 80,000 on Sunday, Asia time, 81,000 a couple of hours back, and this is where we are right now. Let's bring in Subhashri Ghosh, our cryptocurrency reporter. Subhashri, I mean, I look at social media right now, and Bitcoin at $1 million is I guess, something fairly common to see now. Is there any limit to the surge in Bitcoin prices? Is what I want to get to.
That's another $1 million question, David. Actually, the surge, the rally is driven by expectations that Trump, who is known to be pro-crypto, is going to kind of, come up with regulations in the U.S., the biggest market in the world for crypto, and that is leading to this kind of, frenzy, this kind of rally that people are talking about. Yeah, you are right. People are talking about 100K by end of this year. Even $1 million, you never know. But the rally is fed by expectation of regulation coming in there, and that's the biggest primary driver. However, the limitations could be, first, for example, there are quite some known unknowns. For example, you have a new SEC. We don't know who will be the new SEC chair in the U.S. That will be the key driver of the crypto regulation. So we don't know that. We also don't know whether the Trump's promise, whether that the U.S. Bitcoin stockpile will actually come through, whether it is feasible or not. So there are quite a lot of known unknowns that we don't know. So it's pretty hard to say whether this rally will continue or not. But as of now, it looks like many are becoming billionaires.
Not us.
No, but it does sound very nice, actually.
Yeah, good on them.
But you, of course, Suvi, you're talking to traders, brokers, hedge fund contacts. What are you hearing exactly about the bets that are being placed in the areas? Because it's not just that focus on Bitcoin, there's the altcoins as well.
Yeah, a lot of other altcoins. I mean, basically, it's a crypto industry-wide, cryptocurrency-wide rally. As you rightly said, Annabelle, like we are seeing a big rise in Dogecoin, which is promoted by Elon Musk. We also have seen quite a bit of rally in Ethereum, in Solana, in Cardano. So it's basically the entire wave is lifting all boats in this rally. And everybody is benefiting: altcoin holders, meme coin holders, of course, Bitcoin holders. So that's the main takeaway from this kind of frenzy of rally. Yeah.
All right, that was Bloomberg's cryptocurrency reporter there, Subhashri Ghosh in Singapore. And let's move to equities now, because Asian investors are ramping up bets on potential winners from Donald Trump's imminent return to the White House, fueling big bets in some popular stocks. For the details, let's go to Bloomberg's Catherine Nye, who joins us and leads our Asia stocks coverage. Catherine, it seems like some investors have sort of started looking beyond the top-down approach. So if you're going bottom-up, which companies or which areas are you looking at in particular?
Hey, good morning. Yeah, I mean, I think that the Trump trades have been just so well documented, long the dollar, short bonds, and going into, the elections, that was sort of on everyone's mind, everyone's radar, and well crowded. And, as everything fizzles out and we kind of figure out now how things are going to look for the next at least 4 years in the US, traders are saying, what else can we sort of use? What else can we trade to sort of quote unquote generate alpha? And so, traders are talking about Korean shipbuilders, and we're talking about, Vietnamese industrial parks, Australian steel companies. I mean, they're really parsing through the data, parsing through, where people are getting where companies are getting their revenues, and how they might stand to benefit from the fallout from, potential ratcheting of trade tensions between the U.S. and China. They're trying to be really creative now and saying, we're going to look at this differently to sort of continue to make money and to make trades that work. Yeah,
so Korean shipbuilders, Indian electronics, Vietnam also is in play there. Catherine, talk to us about Vietnam. What are we seeing there specifically? What is that thesis about?
Right. So it was really interesting to see on the day of the elections. I mean, the markets were quite volatile, but one standout that you wouldn't necessarily have expected was that the Vietnam stock benchmark was actually up quite a lot. One of the best performers actually in Asia on the day of, as it was becoming clear that Trump was going to win the re-election. I think that Vietnam has sort of positioned itself to be sort of the supplier of choice. A lot of the big Chinese manufacturing and a lot of tech companies are all moving their bases into Vietnam, right? It's become sort of a place for important supply and much more now, given Trump's sort of re-election now. Investors think that Vietnam just as a whole as an economy is going to benefit. And here in the same kind of way, people think that especially these industrial parks where a lot of the manufacturing is made, that these companies are going to benefit. So there was an interesting little bit up in a place that you wouldn't necessarily think or necessarily be on everyone's radar.
Well, they certainly are. A lot more so now, aren't they? Catherine, thank you so much. Catherine Ngai there, of course. Just taking us through some of the Trump trades we've seen here in the Asia Pacific. There is plenty more ahead here on shows. Markets are currently in Greater China on offer. We're off 2.3% on the Hang Seng Index. More on the way. This is Bloomberg.
Quick check on markets. We are just under 25 minutes into the session so far, and actually mostly are in the red today, but there is a sector that's standing out to us, and that's what's happening in the semiconductor space, in particular in the mainland. The sort of broader story here is one from Reuters, and what we're hearing is that they've told TSMC to stop selling some AI chips to China starting today, and so you are seeing TSMC a little bit under pressure so far, even though Citi is saying, for instance, there's going to be a minimal impact. Of course, if TSMC can't send those chips to China, who benefits? Well, it could be names like SMIC, Huawei as well. And we are seeing those. I mean, look at that gain there, nearly 9% to the upside, Dave. Yeah,
as they, I guess, leave some of the business on the table. That's according to the Reuters report that Bell was just pointing out there as well. But I guess the other side to the coin, Citi was just pointing out there, right? So I think it's a big deal for maybe the Chinese companies, not so much for TSMC, which of course is the still your global bellwether bar none almost. Very quickly, industrial metals are down as stimulus underwhelms in China, but at least is the narrative. And we'll leave you with a look at equity markets 30 minutes into the session. This is the China Show. Right, welcome back. You're watching the China Show. Okay, so in fact, since we're looking at a live picture of Hong Kong, I was just browsing my social media right now, and Hong Kong has actually been. So we had a Typhoon 3 signal up over the weekend. The T1 from that T3 has now been canceled, but Hong Kong is now bracing for another storm that's on the way. It's right, I believe, on top of the Philippines right now. It looks to be a fairly strong one, which might make itself felt towards the latter part of this week. That's the weather report for today. Equity markets are off by 2.4%. We are coming off lows of the day, though. Although what's interesting is this divergence now. Typically, you do see the Hang Seng Tech Index, because of index constituencies, fall more than the Hang Seng Index. That's the opposite of what we're seeing today. But suffice to say, that's just many ways of saying things are down today.
Yeah, I mean, I was going to say under the weather, perhaps, if you want to, if you want to go back to what you were saying. Yeah. But certainly, that's sort of the two key themes we're watching. On the one hand, you had the MPC briefing on Friday in China that really underwhelmed. On the fiscal front, people really want to see basically consumption vouchers going ahead and something more around the property sector. You can add to that the inflation figures over the weekend as well in China, and that told us that the stimulus hasn't really taken effect just yet. Different story, of course, what we see in the US session, and it's still that focus, really laser focus on Trump trades and which sectors, which companies in particular are going to be benefiting here.
Yeah, and you have a really big week this week as far as U.S. Econometrics are concerned, because a lot of the Fed conversation around how much they're not able to cut rates anyway is because the U.S. economy has looked fairly resilient, and I think we'll talk more about what the bond markets will look like this week. The Bloomberg Treasury Index, case in point, is not very, very close, but it's on the way. If this continues, it might just erase all the gains year to date in the Treasury market because of just this horrible run of the last, 5 or 6 weeks or so. We're off by about 1% on the Asia-Pacific benchmark. Most sectors, most benchmarks are down, as you can see on your screens. 2 and 10 bond futures are down, so yields would, in fact, be pushing higher as we speak if we had cash trading today. The bright spot across these markets has really been crypto. So we woke up to Bitcoin at 80,000. Maynard went to the office. It crossed 81,000 once we got here. We're 82 right now, give or take here on Bitcoin. Dogecoin, though, as you can see, is outperforming. This one is going effectively vertical if you look at the chart. 30 cents as far as that's concerned. And apart from that, we're still, I think to Bill's point, this is really just one of the Trump trades that is continuing to give this Monday.
And it's an interesting one, Bitcoin, because even though you've got those Trump trades that are really focused on deregulation, actually in the crypto space, it's the focus on regulation and putting some rules in place. But a lot of unknowns. We were just discussing with our reporter, Savashri Ghosh, earlier, saying that we still don't know who's going to be the chair of the SEC, for instance. Yes, Gary Gensler might get fired on day one. Who's actually going to be next in the role, and what do those rules really look like for the sector? But that's certainly one to track very closely. Let's talk now, though, shift back to what's happening in China, because as we were saying, really the Hong Kong session not off to a great start in particular. Let's bring in our MLife strategist, Mark Cranfield, joining us. And Mark, we were speaking earlier about perhaps the outlook for the Hong Kong Stock Exchange, or HSI rather, looking pretty range-bound over the next few months. Is that your interpretation of where we go from here? And how much of a negative is that when you've still got a lot of people talking about US exceptionalism persisting?
Well, traders will be looking at the price action and think we're pretty close to the bottom of the trading range at the moment. That's not a great thing. There's a big point just below 20,000 on the Hang Seng Index, which a lot of momentum traders will be viewing with a little bit of fear, because if that slides this week, it could set off quite a bit of a correction lower in the Hang Seng Index. So by no means a sure thing that we're in a safe trading range as far as Hong Kong stocks are concerned. And the thing is about this, the messaging that came out from the MPC last week, and the idea that people seem to think that we have to be patient before there's more stimulus. China want more time to assess what Donald Trump may or may not do as the next president. But that's the thing with equity traders. They don't really like to be patient. And particularly when you see how much money has built up in Hong Kong and Chinese markets since September, that is not the kind of platform where you can ask people to take their time and consider all the details. They're really looking for quick results. So the continuous momentum in terms of then has to be more positive news. It has to be clear that China is continuing to push with the stimulus measures. And it'll be very important what the PBOC has to say. The most consistent and inspiring thing for markets over the past few weeks has been the sound bites from the PBOC, and also them reinforcing the message that rates are coming down. They put the stock support measures in place. They're pushing the banks to lower deposit rates as well. So the PBOC has been the thing that the market has been watching the most closely. So we will be looking this week for more encouragement from that direction, because otherwise investors could lose patience very quickly with what's happening in China.
Right. And Mark, what else could the PBOC say, though? And the reason maybe I asked that, and I'm not sure if there's, what the answer to the question would be, is could we then maybe see it from the corporates that are set to report this week? Tencent, Alibaba, Meituan, and some of the other big names that are set to report. I mean, may they fill that gap, for example?
I mean, certainly if we get very good results from Tencent and Alibaba, considering they're two of the three biggest companies in the Hang Seng Index, for example, investors will certainly be impressed with that, and it would probably help to boost the mood in the market. But at the same time, people also will be thinking the outlook for Chinese tech companies in general could be pretty uncertain by the time we get to next year. If there are going to be more measures placed on China, the tech sector obviously is one where that may fall. But that's obviously speculation. But in the near term, yes, good results from those companies would certainly help. In terms of the PBOC, people will be watching what they do with the yuan, the currency, and what they do with short-term interest rates. Providing they continue to supply high liquidity in the short-term money markets, that will be a positive sign for equities. And how they managed the yuan. So far, it's been, you can see that they're allowing some flexibility. They're not being dogmatic about the fact that the yuan may need to weaken. They're not standing resolutely in the way. And the market seems to be accepting it pretty well. They're allowing some flexibility in the dollar-yuan movement. The way they're setting the fixing rate is not really to suggest they're putting a huge, okay, I don't want to see the yuan move any further. They're allowing the traders to do a bit of their own thing here, which is probably a good thing, because by the time we find out some of the appointments that Donald Trump is going to make, it could be that he's going to appoint some China hawks in there, and that will be reflected in the currency as well. So the PBOC is doing a pretty good job here in managing the money markets and the currency, and traders will need to see that continue well into next year.
PBOC, Fed as well, Mark, we've got that question mark over inflation. That last mile could be sticky, and so we could see higher rates. That could be a headwind for US equities. At the same time, of course, you've got that prospect of corporate tax cuts. So which one is the bigger player or the bigger market driver, do you think?
I think that the Treasury bond market is really going to have a very interesting period in the next few weeks. There's been an assumption that the Federal Reserve will be cutting interest rates well into next year. And yet now that is very much in doubt. Although for now, the pricing still suggests that traders think there's a chance of December for another rate cut from the Federal Reserve. 2025 is looking very uncertain in that respect. We had the Fed's Kashkari speaking over the weekend. He's a bit more concerned about the inflation outlook. And I think you will see more and more Fed speakers in the next couple of weeks hinting that inflation has become their biggest factor again. It was employment for a while, and it looks like they're going to switch back to inflation. Although, of course, they won't speculate on policies they don't know about for the next US government. But clearly, the evidence so far suggests that upside risks are there for inflation next year. It would be surprising if the expansion of the US economy didn't produce some inflation. That will concern the Fed. And that means that if they do lower rates in December, we could then be in for a long period of holding. They may decide, okay, we've done quite a bit this year, and we'd like to see how the CPI numbers develop in the first half of next year. So it may well be that they will signal by the end of this year that they're ready to pause, assess the data, and that's not really factored into the Treasury bond market just yet.
Mark, thank you. Mark Reinfield there in Singapore for us, our MLive strategist. Really, to Mark's point, right, so a couple of things to watch this week. So you have Singles Day wrapping up effectively in China. On Tuesday, you have inflation numbers coming through in India. Then the bigger, arguably, inflation read is, to the point Mark was making around the Fed, is U.S. inflation coming through midweek. And then the rest of the data, of course, as you can see, wrapping up with U.S. retail sales and activity numbers out of China towards the end of this week.
Yeah, retail sales, of course, in China going back to Singles Day, and what do we see there in terms of the appetite for that shopping festival? We're going to get more on that ahead, actually, because Bloomberg Intelligence thinks that Alibaba's Singles Day gain could top JD's. We're going to assess China's consumption and appetite. Goldman Sachs is joining us just ahead. If you want to get a barometer of how the Chinese consumer is faring, you're going to get a bit of a sense of that coming through in the earnings this week, because we've got JD.com, Alibaba, Tencent, of course. That's really been that story around the China gaming renaissance. Baidu holding its world event as well on Tuesday. We could get them unveiling some AI hardware to the market as well. But let's get more on this now, Dave.
Yeah, well, let's bring in Catherine Lim, our Bloomberg Intelligence senior analyst, to talk us through what to expect from this week's earnings.
Well, you know, it's a busy week, and we've got Singles Days closing midnight, approximately, for most of the platforms. I think, you know, the first sign of any Singles Day or Double 11, we're going to hear it from C tomorrow. Shopee, Southeast Asia, that's actually ongoing in the southern part of Asia as well. But yes, you know, as Belle has actually mentioned, JD.com and Alibaba, Thursday, Friday, they will be the one to actually talk about how well they actually did. And again, we're talking about a lengthier Singles Day shopping festival this year that started as early as the 8th of October, 22 days of October, including another 11 days in November. So there you have it.
Yeah, I feel like they've got to maybe think about a rename of this. It's not exactly Singles Day anymore. It's
everyone's month.
Yes. But I do want to ask, because it's not just, of course, what's in the rear view, it's what's coming up, and a big question mark. What are we going to hear in these earnings calls about the impact of Trump tariffs, for instance, stimulus measures, of course, as well?
Yeah, you know, I guess on potential Trump tariffs, U.S. tariffs to come, it's really too early for any companies to actually, talk about the impact, particularly for Alibaba on their overseas platforms business. I'm talking about AliExpress in particular. And, they are not the only one who's going to be affected because we have PDD's Temu, and then Amazon, who also sources from China. They're going to be impacted if the tariffs actually come through. So I guess that the big question mark right now is when that is going to happen. And I think the reports have it that, it may come like in the second half of next year. So we still have a first half of 2025 to actually play around with. So let's see how the sellers and the platforms react to that. Stimulus, I think it's a little too early for any evidence of that to come. And you're going to see that distortion coming from 2 months long Singles Day promotions that's ongoing. So, I don't think even if we're talking about like a great Singles Day, GMV, etc., that's going to be convincing enough for the markets to actually be more excited about 2025.
All right, that's our Bloomberg Intelligence Senior Analyst for Consumer and Technology in Asia, Catherine Lim there. And let's get more now. Bring in Michelle Cheng, co-head of the Asia Consumer Research at Goldman Sachs. And Michelle, what's your view? Singles Day, Singles Month, are you chalking this up to a success, or what do you think?
So far, I think based on the data we track, but definitely we'll see the whole picture later today. But it's better than June 18. Yeah. So, but partially because it's easier base. Yeah. So a couple of names or sectors more skewed to the Singles Day. Let's say cosmetics. In June 18, they only did like a low single-digit growth, and so far we are seeing like probably mid to high single-digit growth. Yeah. So I think it's improving, but on easier base, and also we see the promotion activity is still pretty intense. Yeah. So, but still better than like past few quarters, especially in second quarter. Second quarter, we see across the whole consumer sector, the growth continue to deteriorate. So at least I think if investors started to see some revenue growth accelerate a bit, and this could restore some confidence level. But definitely we need to see more stimulus, more concrete stimulus to restore the income confidence to drive further increase.
Yeah, we were just joking how long Singles Day was. It's about a month, and then you talk about June 18th. When in reality, it's almost been like an entire year of promotions anyway. Pricing power is not there, and I'm curious to your point on 4Q 2024 earnings. How do you think we're tracking ahead of those results coming through? And I guess consumers still budget conscious at this point. What are you seeing there?
Yeah, so on the revenue perspective, we do see some improvement. So first quarter, we had the companies in our coverage reported 14% revenue growth. Second quarter, third quarter is only 5%. And in fourth quarter, we are having like 11%. But so far, if we hear the companies comment on these quarter-to-date performance, basically limited companies see significant improvement yet. The only exception is home appliance. This is clearly benefiting from the trade-in policy. Okay. And it actually started from late August. And if you look at retail sales in September, everything was so bad, but home appliance went up by like 20%. Even in Singles Day, we see like data is achieving like 20% growth. So I think bottom line is at least we still see something is improving. And if policies support can continue, and it could be easier base for this year. But one thing need to be mindful is first quarter next year base was actually pretty high. Remember, right. Early this year, things are relatively better. So in the recovery path perspective, it could be still bumpy.
We're sort of talking in aggregate here, but let's just drill down, because you mentioned white goods. Maybe that's more of a JD story. But if you think across the platforms, Alibaba, PDD, JD, Kuaishou, Xiaohongshu, Douyin, who's actually faring better at this point in time?
I probably don't speak to our internet teams here, but I think this year we actually see that the big platform, they started to come back. Yeah, and if we look at Douyin, early of the year, people had very high expectation, but actually the growth is still much better than other big platforms, but the growth is slowing down. Yeah, but this also showcases that actually from brands' perspective, they suffer from aggressive promotions. Margin is hit, so they started to talk about whether we need to be more mindful on allocating the resources across different platforms. And also we also hear some more and more brands talk about how to leverage the better omni-channel strategies, because clearly in some cases, offline traffic, if consumers are willing to go into certain stores, the customer acquisition cost is actually lower in this case. Yeah, so going forward, on the one side, this promotion activity has been extended. So this year, you also see the platform also tone down the focus on this promotion. But brands also started to talk about that. But ultimately, at this point, we still see consumers are rational in spending.
This crowding out, right? The crowding out of spending. What about restaurants? What are you seeing there?
Yeah. Restaurant, I think, always is a sector we use that to evaluate the consumption trend in the near term, and so far it's not good. Yeah, so Golden Week is showing improvement. So past few months, like third quarter, restaurant sales only grow like low single digit to below mid single digit, and in Golden Week it's 5%. But after Golden Week, actually slowed down, and usually there's a very big volatility during holiday and the post-holiday. So one thing we need to watch out is hopefully there's some like wealth effect because stock market clearly in Asia is better to drive some better consumption sentiment. And also multiple cities talk about this consumption coupon. Hopefully it can incrementally drive some sentiment. But so far, even if we look at Golden Week, like Shanghai, they issue the consumption coupon, but the help on the restaurant trend so far is quite minimum.
What about the play between the international and the local brand? I saw that Nike, for instance, was doing well in this shopping festival, but is that like an outlier? Lululemon actually stood out as well for China, but is it that story or is it more of the local brands?
Yeah, and interestingly, this time, third quarter result, we actually hear more and more global brands talk about weak China performance across everything. Restaurants, sportswear, cosmetics, everything. High-end especially. But high-end, I think, is different in a way that other category entered a pretty challenging cycle last year. But luxury actually starts to deteriorate more obviously this year. So it's like enter the cycle later than others. But for other sector, cosmetics, sportswear, basically we still see local leaders outperform the global brands. But in cosmetics, I think it's quite obvious because consumers want some value product and also local brands are very good in marketing and product. But in sportswear, it's actually very diverse. Like you said, you still see like Lululemon and some like high-end brands like Dison, A6, they are still doing pretty well in China. But for the big MNC brands like Nike, indeed, actually they see more challenge, although they are still number one, but the growth rate has been underperforming.
Well, that takes us into broader, one of the sectors you like is sports brands. Well, I'll bring in two, sports brands and premium liquor. Why do you like those two?
Yeah, so structural perspective, this is still sector we see the penetration story, even though the market cap is so big. But if we think about the volume penetration upside, that's what we like. We like company or sectors with market share gain story. And this is the one in the longer term, we think there's still some opportunities there. And secondly, they are actively control the pricing inventory right now. So past few months, you do see the volatility in like multi-share price, wholesale price. But we actually see companies, they are actively controlling the inventory, and if they can manage the pricing well, and this is actually good for the share price. And thirdly, given that's a large cap space in the A share, so if we see still positive sentiment on the equity market, I think the share price could still have some support there.
How much of a concern do you see for some of these local brands that are exporting abroad? Because I think, to your point, you prefer companies that have a market share gain story and they've got structural growth opportunities overseas. How much of a concern, then, is that they come up against Trump tariffs?
Tariff, actually, we can break down into two baskets. One is the pure exporters, like Nike, Adidas, they source from China. But these kind of like exporters, they have been doing well reallocating their production base to other countries. So if we are talking about purely like China to US export, these groups actually have much smaller impact than 2016 to 2020. Yeah. But the other basket is companies like some white goods company, home appliance company, or some retailers we like. These are a bit different from pure tariff story. It's actually more like leverage good product innovation capability, supply chain efficiency, and they are exploring the global market, not only US. Actually, quite a few companies, they have very balanced global exposure these days. US is big, but it's probably only like 20-30% of the revenue, not like 70-80% as before.
Michelle, I'm curious, how many stocks do you cover total?
So our team aggregate cover around 100 stocks.
Oh my God.
Yeah.
All right. Sleepless on the sell side, as they say, in earnings season. Michelle, thank you so much. Have a great week ahead.
Yeah, thank you.
Michelle Cheng there, co-head of Asia Consumer Research at Goldman Sachs. Speaking of consumption, we just talked about the Lululemon story. You can read about that and how the company is looking to defy the slowdown as it hits $1 billion in Chinese sales for the first time this year. The article also is available on the terminal for subscribers or also on Bloomberg.com. This is Bloomberg.
Taking a look at a stock in Australia this morning, this is Resolute Mining. It's listed on the ASX 200, and we're actually seeing shares, well, they're significantly plunging, down the most since 1988, but it's really not a great story here. The CEO, essentially, of the company, Terry Holohan, has been detained by the military-controlled government of Mali. He's also been detained along with two other company executives, but there's certainly been a pattern of arrests that we're seeing in Mali since last year, actually, but we did actually see 4, for instance, detained from Barrick Gold. Resolute Mining is saying that it's working to settle the claims with the Mali government to secure the future of its gold mine in the country, Dave.
Yeah, quite a concerning story. As you can see, markets are reacting urgently to that specific piece of news here. Very quickly, before we go into the Japanese lunch break, Sony is a positive story. That's an earnings beat. Shares are up 6% in the morning session. Plenty more ahead. This is Bloomberg.
It's 11:29 a.m. in Tokyo. Japanese markets, traders, they're 1 minute away from their lunch break this morning. But in terms of the moves today, you've actually got the Nikkei a little bit under pressure, but not as much as we're seeing across the broader benchmark today. And the story perhaps is it's a bit of wait-and-see mode happening in Tokyo as well, because you've got, firstly, some mixed corporate earnings coming through. We're just mentioning Sony, for instance, one of the biggest advances today. There's plenty, though, moving to the downside. So mixed earnings coming through. You've got the outcome of a parliamentary vote. Yes, Ishiba is expected to be appointed the next prime minister, but still a bit of uncertainty around that. And then the big... I'm going to say elephants, not just elephant in the room, but there's firstly Trump tariffs. What does that mean? And then you've also got the impact of China's disappointing stimulus measures plus the economic data over the weekend, Dave.
Yeah, plural. Elephants.
Elephants.
Elephants. With the nets. And all of that conniving to push markets lower, down 1.2% now. And a lot of this has to do with this pullback we're seeing just about across the board in the sector basis, this pullback we're seeing here in Hong Kong. In fact, earlier on, what explains this knee-jerk reaction in markets? We spoke with China Renaissance, and this is what they had to say.
There is a belief and some sense that maybe they're holding back. Maybe they're waiting for the Trump administration to start. They're maybe holding to see what these tariffs come aboard. Do they come into a 60% across the board leveling, or do they become more targeted in terms of some specific stocks, specific sectors? So I do feel that there's a lot more behind the MPC. I do feel that there's a lot more behind the stimulus. And I think that the market at the moment is having a very negative knee-jerk reaction. It's
And that knee-jerk reaction has now taken the Hang Seng Index. In fact, we were just talking about the session lows now about an hour into the session, and we're now approaching, and this is a significant level to watch, right? 19,977. That is the low of the recent range. And as you can see on the right side of your screens, we are approaching that level. And Mark Cranfield flagged this level. If we take that out, a lot of momentum traders will take that and maybe take this market even lower, given the markets and sort of given all the, I guess, disappointment on the eco front. And I think some of the banks that have come out also talking about this.
Well, UBS is one of those, and you can kind of go through that. But I think the question is, well, what have we had so far? Is it enough for them to safeguard their GDP target for this year of around 5%? Because some are saying yes. UBS, though, it seems, is saying actually probably not.
Yeah, a lot of it is also, if you wanted to hear something around growth, you're probably disappointed. If you're probably hearing something about how they're managing to unlock spending capacity going into next year, maybe this is one of, but to your point, right, UBS just came out and cut their growth forecast for China to around, I think it was around 4%. Around 4% for next year, and considerably lower for 2026. Let's get the sense right now from Chang Shu, our chief Asia economist, to talk us through what was your initial take from the debt plan that was announced on Friday?
I think we are slightly more positive than the market. We think that swap program itself, we think it's a positive, but we do see the need of wider push to support the economy. So if we start with the debt program, in terms of its size and pace, that's what we expected. There are different resources, new resources plus regular resources. There's a total 10 trillion yuan of debt to be swapped out of the bad sort of implicit debt the local governments have been burdened with. So that's something positive, and we think this round the debt swap program is more decisive than 2015. In 2015, there was just announcement of 1 trillion. Initially, even when it ended up doing much more in the end, but this time it's sort of much more positive. And the reason we're slightly more positive than the market is we have always argued the debt swap program itself is stimulus, because we have heard so many stories of local governments, because of the heavy debt burden, they're not able to pay the teachers and drivers, they're not able to pay private sector companies. With this sort of debt burden lifted, at least kind of reduced, they can better support the local economy. They can maintain the basic operations and put some money into support the economy. But I agree, wider push in other aspects are needed.
Yeah, to that point, I mean, it seems like maybe they're keeping a couple of cards up their sleeve, but which ones would they be likely to pull out, and also which areas are they trying to fix? Property, for instance, multi-year story, consumption, another one as well?
Yeah, I agree with you. I think we outlined 4 components. The first component is debt swap, that's out, but support for the demand, kind of demand side measures, support for the housing market, and also injection for bank capital. That's also needed. And I think the signals are quite strong. They are going to support demand, and they are talking about. Our sense is they are going to reorientate much more than before towards supporting demands and investment, private investment, and consumption. Those are very important aspects, but we do see that's needed at this point. I think for this year, it's something we have argued for some time. For 2024, because the government has been slow. Was slow in the first 3 quarters. We don't have the October data yet, so we can't make a judgment on that one. So they were slow on spending in the first 3 quarters. In the remainder of the year, they have to catch up with the spending, which is why they're not able to kind of unveil additional spending for 2024. But we do see the sort of spending to ramp up in 2025.
Yeah, and they have signaled as much as well, some forward guidance there on perhaps what hasn't yet been announced going into next year. The Central Economic Work Conference is the next one to watch, of course, in China, because they then decide on what the targets will be that they will announce in March of next year at the 2 meetings in Beijing. Chang Shu there, our chief Asia economist there. Plenty more ahead here in shows. We're about an hour and 6 minutes into the cash market session, and things are selling off. We're down 2.6% on the Hang Seng Index, off by 1%. The rest of the region are down, but not out. 9 cents of 1% on the Kospi Index. Markets falling out of bed this Monday somewhat. This is Bloomberg.
taking a look at really what's been one of the most read stories over the weekend. Bitcoin topping $81,000 a token for the first time ever. If there's really an asset class that trades in lockstep with expectations around Trump, what Trump can deliver to the market, it's been cryptocurrencies, because we've really seen them running up basically with this anticipation we're going to perhaps finally get some rules for the sector in the US, and that is going to be broadly positive for institutional adoption. It leads to, again, more price activity discovery in the space. But let's get more with Angelina Kwan. She's CEO and founder of the consulting firm Stratford Finance. And Angelina, I'm curious for your views. This anticipation that we see President Trump coming back in, spelling out some clarity for the sector in the US in particular, how much of a positive and how much is that needed for the asset class?
I think it's very, very positive for the asset class, and it's vindication as well as a proper approval that digital assets are a asset class for the future and present. And I think it's going to be very, very exciting. The fact that the expectations that now Bitcoin has hit 81,000 is very, very positive. The thing that's really necessary, though, for the United States to be a leader in digital assets is to have a very, very clear regime. And now with the expected appointment of Hoskinson, who is the Cardano founder, as this head of the input-output group that will be commenting and giving advice to Trump and his party, I think it's going to at least start moving. The interesting part will be how will the different bodies within the government from the SEC, is it going to be the SEC who will be the lead regulator, or will it be the CFTC that's going to be the lead regulator? And then how will these rules work out? And I don't think anybody should expect that it's going to come just like that. It's going to take a while because legislation takes a while. But the fact that there is a plan that is in place, once one is put into place, will be good for digital assets around the world. I was just at a meeting recently working with many of the regulators, and it's very difficult because the United States, one of the biggest countries, and many of their digital asset firms are leaders in the field. It's very difficult for them to get licenses around the world because the regulation is so unclear in the United States. And I think that clarity will really help IOSCO and the other regulators around the world to work with the U.S. Does that help?
Angelina, David here. Oh, no, yeah, absolutely, it helps. In fact, I was just going to build on that and just to ask you, these things are going to take time, right? The fact that we're talking about it in a formal manner, I think, certainly helped. What would be the specific goalposts you'd be keeping an eye on? What do you think can happen over the next 12 months, along this sort of progress, this path of progress here?
I think, number one, for the United States, they're going to have to decide who will be the lead regulator, CFTC or SEC. Then they need to decide how they want to regulate, and that's going to take a long time for consultation. Even if you look in Hong Kong, we took roughly about a year to get everything together in terms of our licensing measures, and they're very clear now. But just getting the legislation passed, and that's moving very quickly, in fact, does take time. And the United States, you're going to have voting within houses and different bodies within the United States. Whilst I see that the Republican Party does control both the Senate and the House now, it will still take time because not everybody is on the bandwagon to approve digital assets as a full asset class. But I think it's on the way there. And if the different bodies can work together, then they can actually move a bit faster. Then international work will be very important with the United States. The U.S. is a very important part of the International Organization of Securities Commissions, and they've been taking a lead. But it's been enforcement by taking cases. And what will be great is to actually have legislation in place that people can understand how to be compliant so they don't get sued or thrown into jail. and they know what is right and wrong very, very clearly. So that will really help with the institutionalization of digital assets moving forward.
Angelina, we're just showing a graphic here, taking a look at some of the ETFs in Hong Kong, and we are seeing a big run up today in some of the names. How much broader does this activity come in terms of the regulatory piece? Because we've seen, for instance, certain altcoins trading in anticipation, Solana being one that you could see ETFs linked to that asset class. In Hong Kong, for instance, we've had a really big call for derivatives or derivative-linked products as well to try and broaden that asset class in its entirety.
The market is really asking for risk management / derivatives to be there, because what you're doing is you're just buying the asset, but you can't hedge. So one of the key points that has been requested by the institutions as well as the investing public is derivatives, and the fact that for example, the CME derivatives are so popular, but that's the only place where institutional investors can trade now. If we can launch that in Hong Kong, that will be a very big game changer. In terms of the fact that we have ETFs and we have a Bitcoin and a Ethereum ETF, I sort of think that it pushed Mr. Gensler's decision-making to also approve that in the United States. So I think Hong Kong has helped in terms of the Hong Kong government as well as the SFC working together to really push the ETFs out. And I think there will be more ETFs, of which Solana is one of the major ones that have been discussed. The regulations have been very, very clear for custodians also in terms of, so we have an infrastructure and we have a very clear roadmap of how to launch products now. So now that will be a great runway for Hong Kong. But a lot of countries don't have that yet. And I think for Asia Pacific, a lot of the different markets are looking at what Hong Kong has done. I just came back from a conference in Taiwan, and they've just made a decision to actually move into digital assets. And they're really looking at becoming also a digital asset hub, as is Malaysia, and Singapore already is a digital assets hub. So you're seeing all the different countries moving into this area, and you're seeing institutions being a part of this and moving into it. So they're all interested also in listing digital assets as ETFs, and also getting into the risk management / derivatives side. So in all, if we can get this together, you're going to see an immediate and very fast-moving institutional take-up of digital assets, faster than I've ever seen in any other asset class. And that's because people have already been preparing. We've got custodians, we've got major international banks that are shoring up their custody services, that are getting ready to offer digital assets to their clients, fund managers around the world, and so on and so forth. So I think once the U.S. gets their legislation very clear, and we hope that it will be very pro getting licenses, doing this right, putting out proper guidance, and then getting that whole regime together, and then working with the international regulators, then we'll really see an exciting digital asset space that will be just growing and growing, and could at some point even equal or surpass traditional finance. At some point, a little while.
At some point, okay.
Now, at least.
Well, yeah, we can revisit the progress report as we head to that. Angelina, thank you so much for joining us today. Angelina Kwan, their CEO and founder of Stratford Finance. Plenty more ahead here on the show as equity markets across the region are on offer this Monday morning. This is Bloomberg. Welcome back. Here is what's trending in China. It's our look at what's making headlines in national newspapers. We'll start things off with the Securities Times here, reporting that the government will implement stronger fiscal policies to support growth after announcing a $1.4 trillion debt swap plan. Now, analysts quoted in the paper say China may allow a higher fiscal deficit and issue ultra-long special sovereign bonds. Now, they say China's debt ratio gives it relatively large room for borrowing.
Yeah, and you're also seeing the Securities Times there, sort of a similar theme coming through there. They're flagging the need for expanded, more targeted monetary policies, and the economy, as we know, really remaining under pressure. We saw that in the inflation readings over the weekend. But analysts are saying the paper, or telling the paper, that there's a high probability of RRR and interest rate cuts by the end of this year, while the deposit rates are also set to fall.
The other piece of news that's also gaining some traction right now is this territorial conflict between China and the U.S., also taking up a lot of space, really. When you look specifically at Chinese state media, that's after Beijing released certainly the baseline, the details, the specifics here of its territorial sea adjacent to the Scarborough Shoal. Let's bring in Min Lo, our China correspondent, to give us really the context. Well, we've been talking about the story quite some time. So why is this specific development important?
Yeah, so we all know that there has been increased frequency of these clashes, the ramming of vessels and the firing of water cannons in the South China Sea. And what happened was on Friday, the Philippines president had signed into law 2 separate pieces of legislation that is meant to strengthen the Philippines' maritime rights. And that drew very strong condemnation from Beijing, which 2 days later issued its own set of baselines for the territorial sea adjacent to the Scarborough Shoal. And the Chinese Coast Guard said that they will strengthen patrol in this area. They are accusing the Philippines of stoking tensions here by sending their own Philippine military vessels to the area. And China also said that these Philippine fishing vessels in the area are operating illegally. So this, in some ways, it is nothing new, but it is perhaps Beijing's way of responding proportionately to the new laws that the Philippines had enacted.
And as David was just mentioning, it's something that's been quite actively discussed on social media. What's sort of the read-through in terms of what people are saying?
Yeah, on social media, I was seeing predominantly very nationalistic comments, echoing what the official stance is, which is that, we really should resolutely defend our territorial integrity, that this is something very unreasonable for the Philippines to do. And for some context, for many Chinese that I've spoken to, the issue of the South China Sea is really something that is black and white for them. It's not something that is disputable, because they have always seen this area as part of their historical territory from the Han Dynasty until now. And Philippines' claim for it in the Chinese eyes is something that is very recent. And so that's why a lot of Chinese people are just very aggressively defending this and saying, we should exploit those areas, turn them into tourist attractions, for example. Also interesting, the Ministry of Natural Resources had published a list of 64 names, Chinese names, of these reefs and islands in the South China Sea with their pin-in as well as the specific coordinates. So it's another effort by the government to really put their stamp on these features in the South China Sea.
Right, that was our China correspondent, Min Lo, there, really wrapping up what we're hearing on social media. But the markets today is also really focused on that briefing really from Friday, because we had the MPC coming out and talking about this new debt swap program that has underwhelmed, I guess you could say, given that, yes, you've got that aid for local governments. Do we actually get new stimulus coming into the market? No, it's really that focus on maybe just leaving a little bit of room there to sort of try and address the Trump tariffs rather coming in next year. But today you're really seeing that big reaction coming through in the property and the consumer stocks in particular. For instance, the likes of UBS is saying that really for it to be something positive for markets, you've got to have a lot more money coming through, and it needs to be targeted at trying to turn around sentiment in those areas in particular.
A lot of it is also, to your point, right, it's optics. So we were speaking with Bloomberg Economics earlier on, and they actually think the opposite, that this is actually stimulus. It's just that the local governments will then need to be able to deliver that stimulus through more spending because they've been handicapped. Now the other question is, what do we call it, right? Do we call it a direct-to-consumer coupons? Is that going to be something that markets will be more receptive to? Maybe it's the way we call it. Maybe it's the big number. The other point, too, is, and I think the story actually also highlights this, that the fact that we now have the prospect of tariffs coming through next year, to your point, they might be saving the bullets there, right? In the event they might need to introduce something more. And I think Min, who we just had on, actually made a very good point earlier on, where she talked about the next one to watch is the Central Economic Work Conference in early December, because that's where they decide really how big the budget will be that they announced back in March of next year.
But to your point, I mean, sort of waiting around what Trump means for China, I think we're already seeing that geopolitical risk, and it's never really going away, because you take a look at what's happening in the chip space today. And actually, it's interesting, TSMC's under pressure because they're being told, don't send any more of your AI chips to China. I mean, we're not talking about the most advanced. We already know there's bans in place. It's sort of that lower level AI chip. Maybe there's some benefits here, and we're seeing, for instance, SMIC, Huawong Semi as well. They're gaining off the back.
Yeah, well, they're receding from that part of the market. That's it from us here. This is Bloomberg.